So we're seeing a revival in investor sentiment towards Asia and China-based PE and VC funds. Fundraising activity is rebounding, and AI is rising as a powerful catalyst for all of these events. So we're here to discuss the opportunities and risks shaping the sectors. Before we dive into the panel, we do have a poll for all of you in the audience. If you scan the QR codes, we can see that we want to see your view about where you see the strongest growth potentials in private markets, and later we'll dive into that in the session. So for starters, Jenny, I'd like to ask you why you think that we're seeing all this fundraising activity in the past year and a half, and also, is there enough LP appetite to support all this activity?
Great, thank you, Lulu. Very happy to be here. Well, I have been in the private capital or private investment area for close to 2.5 decades, coming to 3 decades, 30 years. And I would say that in the private market or private capital perspective, the fundraising cycle generally is on a 3 to 4 year pace. And triggers for whether the fundraising cycle is accelerated or prolonged is highly dependent on 2 key factors. I think one is there a specific tailwind in terms of technology disruption, in terms of broader market change that's going to create new ideas, new companies, and new products in the market. Well, I think for us, the answer is yes, right? Today, in every single conference that you talked about, obviously the whole AI transformation is changing industry, not in small ways, but in very broad ways, and we can deep dive later. Then the second trigger, which is actually a very important trigger, is the liquidity at the end of the closed fund, right, in private capital. And so for the last 4 to 5 years, I have to say that the IPO market has been shut, not just in particular regional markets, but on a global basis. Now, as we all heard this morning as well, Hong Kong is top of the chart, league tables in terms of IPOs. We'd like to see that continue, not just in Hong Kong, but on a broad-based basis. And if the IPO market can stay healthy, can stay open, then I think you will close the loop on private capital. So with that as well, right, tech transformation, close the loop. Investors do need the capital to come back in the form of distribution and cashback and returns. And so with that as well, definitely managers will then be in a position to say, hey, let's raise a new fund to capitalize on the potential investments and new ideas. But also I'd like to add, right, in the private capital world, it's all about the power law, right? You can call it, the K-shaped dynamic or the power law. Even in the AI world, we're talking about, the power law of the frontier model. And so similar managers in the private capital markets, the matured managers do enjoy, a bit more excitement around, their new fundraise, their new products. And so I think from a capital perspective, it also does flow towards a bit of that power law, which is the top 10, top 20 managers on a global basis. So I would say it's not bad for everyone. It's not bad for every strategy, but for managers that's been, consistent, long-term, delivering consistent return, measured in terms of how they build their portfolio and their pace, I would say look at this asset class on a 10-year horizon, but not a 1 to 2 year horizon.
Yeah, so we're simply in that cycle, the exit strategies help, and also the top performers are taking most of the money. And Mingchen, that's a perfect segue to you. You're sitting as an LP, have a broader view of all the funds. How are you taking all of this demand in the market, and what's your view on it?
I think in the last 1 to 2 years, we clearly see the recovery of the interest level from the international LPs for Asia private markets, particularly for China. As all we know, after the peak of 2021, China has entered a downturn in the last few years, quite challenging. A lot of funds had very big challenges to raise a new fund. I think after the maybe late 24 and also the 25, we've seen a very strong recovery on the public market, as Jenny mentioned, and also a lot of interesting investment themes come out of China, AI, and also a lot of go abroad, buyout, and also not only China, we also seen a lot of non-China Asia markets like Japan, India has also growing very well and attracting a lot of international capitals. So for China specifically, because we're talking about China more today, We've seen we've seen quite a few top-tier venture capital manager have raised the new fund, and which is very encouraging. But unfortunately, on the other hand, many of them have cut back the fund size to like 50%, 60% of the prior fund. So they're raising a smaller fund. They're investing more focused on the strong momentum right now, like AI, robotics, and other hard tech, deep tech innovation of China. And on the other hand, we're also seeing the increase of buyout investments in China, which is also a phenomenon that you see in some mature market. So like Japan, Korea, Australia, in Asia. So in China, we also see the increase for buyout as a result of the consolidation of a lot of industries and supply chain restructuring, and a lot of business succession of the first generation entrepreneurs. So a lot of interesting themes also happening in the bio space in China. So, and we definitely see the capital moving a little bit from the other regions to China, to Asia, as diversification. And as we all know, in the last few years, we've seen a very, very high level of concentration to the US on both the public market and the private markets. Particularly for the private markets, very, very high concentration to AI. We don't think this is a very healthy situation, but some capital are already started to diversify a little bit to this region.
Yeah, that concentration in AI is something I want to talk about. So both of you have exposure to AI. What, in your view, is the real gap between how much of a gap does China have with the US? And we can talk about like the different sectors, and also how much time is there between the chip race, the time lag between the chip race. Jenny, do you want to start first?
Yeah, so I wouldn't characterize this as a gap. AI has been around, machine learning, traditional has been around for the last 20, 30, 40 years. I think what really was exciting was the OpenAI ChatGPT moment, which was the early 2024. And then, of course, in 2025, we have our DeepSeek moment. And frankly, if you look at where the frontier model has emerged, whether they are closed or open source, this all happened within the 12 to 18 months time frame, right? And so very quickly, the world got to know about frontier model. And whether you are using your ChatGPT or your Anthropic or your DeepSeek or your Llama or your Gemini, the underlying, if we were to call this operating system for AI compute, actually it's already there. And very quickly over the last, the 18 months, I think that battle there has now shifted into the stack, right? And so it's no longer about who has the best frontier model. To be fair, the scaling law has plateaued, and therefore it's the differences on that frontier model portion is very minimal. It's really now about application, and so and then it's about and obviously on the frontier model as well, it's also moved from the private capital market very quickly into the public market. Right, and so from a private capital or a private capital VC investor, then where we are focused now is where are the problem sets, where are the industries, where are the verticals that's going to be enhanced, whether it's AI native or AI transform. In this case, I think we have seen that in the US market or in the West, a lot of the SaaS, software type processes, whether it's around legal, security, as we all know it, audit, I think there is a lot more emphasis in terms of the AI transformation on process, on kind of software-defined process. On the Asia side, the issues and challenges that we face is a little different. SaaS had never taken off in Asia over the last 20 years, simply because the state of the economy here is very diverse. We've emerging, we've developed, different GDP per capita, ability to pay for software type services is not there. Right, and so in Asia, I think where AI comes in, it's actually down to the industries. So we are seeing factories transforming themselves, whether it's automation with robotics, embodied AI, with physical AI, with agentic AI in the bots, in the hardware, in the machines. That's one area. The second area we are seeing is actually AI for science, right? And so the Asia broadly has 5 billion of the population here, and therefore different different regions actually has different healthcare related issues, which I think the challenges does then presents itself where if AI can transform, this is where we are seeing AI native transformation in the area of healthcare, in the areas of medical device, in the area of drug discovery. So yeah, I think the world is better off because we are focused on solving different issues that's pertinent to each of the region. And I think that the world will be even better off if there's a lot more sharing, among the entrepreneurs and on the trends perspective.
So focusing on the hardware, robotics, and also AI for healthcare, that's where Asia is like seeing its strength.
Right. Local challenges that it's going to be more transformative for the general population.
Yeah. And Mingchen, what's your view on that?
Yeah, I think in terms of the comparison between China and US in the AI space, I think both countries will continue to compete, but I think they are taking a little bit different approach. I think in a large language model side, personally I feel US is still leading. To what extent, I'm not sure. Maybe Jenny knows better, but I think on the surface you see the strong revenue growth for some of the leading models in the US. So I do believe the valuation to some extent is really well supported by the growth of the ARR. But I don't think the gap of the technology is that big, right? So Anthropic is raising a new round. How much is $950 billion US dollar, right? The valuation. But you see some leasing company in Hong Kong. The model here is 500 billion Hong Kong D. The gap's 15 times, 20 times for the valuation. I don't think the gap is that big, but it's really the problem, the difference of the commercialization, the capability of commercialization. Why is it different? Because the US clients, global clients, are very willing to pay to purchase this service. But in China's, we don't have a very strong tradition to pay. This is why we don't have SaaS industry at all. And we're worried about the SaaS partially will be replaced by AI. But good thing here is we have nothing to replace. And so I think on the model side, we still see US leading. But on the other hand, for the physical AI, like robotics, autonomous driving, and industrial automation, those areas are definitely China's leader and is much more advanced than other countries, including US. This is supported really by the very comprehensive and sophisticated manufacturing capability, and also the large pool of talents, including scientists and engineers. So US doesn't have that. I think China will continue to lead. And also very importantly on the valuation, again, even for the similar kind of business in a similar commercialization stage, the Chinese company is still, the valuation for Chinese company is still much less, much cheaper than US peers. This is why we think here China AI is very attractive to invest, and from both technology and the valuation perspective.
Yeah. The challenges you mentioned about selling to companies to be model has always been there, and that's probably why this part of the region is more leading in terms of commercial applications, and also DeepSeek is in no rush to commercialize either. So I have a question about the post-Manus world. I know neither of you are in those deals, but as an investor, what is your advice for companies starting their business today if the founder were to want to sell to the world and be a global business? Where would you advise them to, how would they build their business from day one?
Yeah, I would say that, the world has changed, and because of that, when we talk to our founders, the conversation has gone from efficiency-based to more resiliency-based. And in a more efficient world, it's about where do you build your one large data center? Where do you build your one manufacturing facility? Where do you house all your R&D? Because in efficiency base, you need scale and you need leverage. In the new world, as we know, I think markets are different. Even when we talk about AI, the willingness to pay by the end customer in each of the market is different. And so in a more resiliency-based conversation, really it's about, what can your product do? Where can it be sold? Who are the most likely first phase or second phase customers, then that's maybe where you put your go-to-market engine. In terms of R&D, I would say that in the new world, obviously with AI as well, it's also about data. It's about model access, it's about data, it's about how much of the processing are you going to do. And so in that sense, it also means that founders have to start to think about multiple provisioning points, right? Whether it's to house their R&D, their IP creation, as well as how they manage data. So in that sense, today's companies do have to have multiple points. And then the last one is about manufacturing, right? If you're building robots, or while we definitely, I think in terms of talent, in terms of ecosystem, in terms of access to sensors and all the, different pieces of the manufacturing ecosystem, China is a very strong ecosystem in terms of the process and the talent. But the reality is that customers want the manufacturing closer to them. And so even for founders, when they think about manufacturing, it's not one big factory for the world. And therefore, what we are seeing is that there's probably a China for China, a US for US, and then somewhere else for the rest of the world. And it does require, while AI is supposed to be more efficient, but today in trying to be a global company, it means that on day one, the capital, the thought process that goes into structuring the right company to be in the right place, right time, right market, right customers means that there will be more, expense associated with them.
And do they have to do it as early as possible?
Well, so I would say that if you're a first-time entrepreneur, then definitely, right, you have a clean slate and you're looking at where the world is and you can position yourself the right way. If you are an existing large company and, then I think, and you're looking to spin off your companies, then obviously the conversation is a lot more nuanced. I think our advice is always, be what you are, right? I mean, if you have China's strength, you should leverage on the China strength. If you want to go to market, in international market, find partners that will allow you to lend. Some markets may be off limits and it's not where they should go, right? So I think for the mid to later stage companies, the conversation is a lot more nuanced. And I think that it has to be also very transparent. We always said don't try to be cute because the world isn't cute, right? And information, transparency, it's all out there. Your customers know, you yourself know. And so whatever you do in terms of structuring your business, just make sure that it can stand the test of conversation, or you can stand the test of, media or headlines. I think maybe that's the litmus test that our founders found after they decide what they want to do to go through that litmus test as well.
Standing the test of conversation, meaning the optics are as important as being legally compliant.
Absolutely.
So let's have a look at the poll that we did earlier. Where is your highest conviction in Asia private markets over the next 2 to 3 years? And our winner is growth equity. That's a perfect segment into our next question about where you two are putting your money in. Jenny, you mentioned about the robotics and healthcare companies. I'm curious about your investment strategy and what companies you're investing in.
Well, I think at the top level, that Mingchen and I, we are very bullish on Asia. I think if you look at global capital, Asia, in terms of allocation, has gone from like 10% of global allocation down to maybe 5%. So we're nowhere near, back where we are in terms of capital coming back into Asia. But Asia broadly, as we talked about, there are 3 centers, right? Japan, China, and India. And we are seeing a lot of growth here. And so I think just reacting to what we're seeing here, I would say that we continue to see with AI transformation, not just early AI native companies coming out, and therefore the venture capital market is coming back. I would say stabilizing on the way up with quite a bit of excitement. But where it's quite transformational is that we're seeing mid to large cap companies really thinking about transformation with technology. And how they can better position themselves. And so having access to whether growth equity or private capital, private credit, I think that's where we are also seeing a lot of excitement as well. I just want to maybe add that. And then I think Lulu and I, we were discussing about, if I'm investing just on my personal perspective and I'm looking at 10, 20 years, what is the one area, if I can only pick one area, I would say that I would double down on AI plus longevity. I think I like to be able to do this, every 5 years. I've been doing this for 25 years, 26 years. Maybe we'll do it for another 3 decades. And to do this well, we would need AI for longevity to actually come earlier.
And Mingchen, you're investing in funds, right? So what types of funds are getting your pick these days?
We have a lot of different strategies, different funds, and there's a lot of things to do to invest. I remember you asked me on our prep call, so how to build a portfolio. So I'm a private market specialist, so I don't comment on the public market, but we have a very strong bias towards private markets. So if I think about my own portfolio, I would put 50% of money to the private markets, not 20, 30, as some other would say. So 50% of your portfolio to private markets. Within that 50%, I think on geography allocation. So I would still put like 50-60% to the US, because the US is still the largest private market in the world. And other than US, maybe we can put some 20-ish in Europe, and then 20, 30 in Asia. Again, we have strong bias towards Asia. So if you are neutral to Asia, that's about 10 to 15% of the global market. That's neutral, right? But we want to maybe overweight a little bit at this point. And that's by geographies. By strategy, I would think globally, buyout is still the largest part. So maybe, again, 60%, even 70% to buyouts, and then the remaining 30% for venture and growth. From a long-term perspective, venture and growth has been like actually 10 to 20% of the global PE market. So right now, people are getting crazy on venture because of AI, but from long-term perspective, I think 30% is roughly a reasonable allocation to venture growth. I know this is very boring. We are boring investor, and that's a very long-term, stable, and diversified and a safe portfolio, I think, for your money.
I'm curious about the dynamics between the LPs and the GPs these days. Out of the US, we're seeing much tougher clauses and also negotiation terms. What are you seeing on your side of the table, and what's the conversation like? Where's the strongest tension points?
Yeah. I think a few, 3-4 years ago, after the downturn, we clearly see the LP are taking a little bit stronger position in the dynamics. But I think we see the market is starting to normalize and will continue to normalize to a level that the GP LP dynamics will more based on the quality of the investment, quality of the funds, quality of the GP. If you're very good, very strong GP, you tend to take a stronger position in those in these negotiations.
Looking at each other.
And so it's really depending how strong your willingness to invest in this fund, right? So I think we're seeing the normalization of that dynamics. Yeah.
If I may jump in, I think let's just on venture capital as an asset class. If you look at the returns on a 10-year horizon, has always been probably the best asset class on a 10-year horizon. Of course, venture capital over the last 5 years is the worst asset class, right? Because of the lack of liquidity, the IPO, and of course, prior to the AI moment, I think there was also a bit of a limbo in terms of where the next technology innovation is coming from. So if you look at the 1-year and 5-year return on venture capital, I think you're talking about maybe the teens, and this is average, right? 10 to 12%. From a return perspective. But I want to highlight a point that Mingchen mentioned, and that's the dispersion between a top tier, first quartile GP and the last year is easily a 30%, so 300 basis point of returns. Right, so if your average is at the 10-12%, then the best managers could be generating 40-50% of IRR. And so I think when you are in that camp, you would have a lot more bargaining power when you think about consistent returns and terms negotiation. Yeah. Obviously, if you're in the long tail, then it's going to be a much harder conversation.
Yeah. And in the secondaries market, quite a lot of activity on that front. How much discounts are we seeing for these types of secondary funds?
Yeah, I'm very happy you pick up this topic. I also see that 20% of the audience are picking secondaries as their as a class. They have high conviction. I think this secondary market is growing very fast in Asia. and we're seeing a lot of interest right now. But in terms of the supply-demand dynamics, I think still we're seeing a lot of investment opportunities, but on the other hand, the capital is, relatively speaking, is still very limited. So this is why we still think the secondaries market in Asia is still a buyer's market, and we still have the luxury to pick good assets, good GPs, good funds to invest, and still the discount is still relatively larger than the similar type of opportunities in the US.
Where
for example,
that range?
Yeah, for venture fund, sometimes the discount range can from 20% discount to 50% discount, sometimes even higher. For the buyout, maybe 10% to like 30%. So venture tend to have deeper discounts given the early stage nature of the portfolio and assets. But also this is also highly related to the funds, the quality of the GP of funds and underlying assets. So this is why to invest in secondaries experience and the knowledge.
If I may quickly add in, I think when the IPO market opens, actually the secondaries asset class will actually go down in terms of priority. Simply because for companies, to be fair, we are seeing companies go public shorter time, faster as well. And so if the IPO market can stay open, I would say that the same companies that may be looking for to exit, right, through secondary sales, or LPs looking to exit for secondary sales, probably will tone down a little bit, right? Because then these companies are then getting to the end of the exit pie. So if anything, I would say private credit is probably a better asset if you're looking at Asia, because it helps to capture not just AI or tech native companies, but also the transformation that would change even category leaders traditional into new, tech transform companies. So I think credit is one way because it's non-dilutive capital. It allows the same companies to be able to tap the expertise with tech transformation, but in a private credit manner. So I think underserved asset class definitely worth a seat at the table from the growth that we are seeing in the category.
Yeah, one final question for your fund in terms of exits, what's in the pipeline, whether it be IPOs or M&As?
Absolutely. So across all our equity funds, we've had 6 IPOs in the last 12 months across the Asia markets. We have actually close to 20 companies for the next 12 to 18 months. And again, across the different markets from, of course, Hong Kong takes a big lion's share of this, but also includes, India market, Japan market, and the US market as well. So that's why I said we need the market to stay sane and stay open.
Right.
For returns back to our LPs.
Yeah.
One final question. If you had $100,000, where would you put it?
Yeah, I think I answered this, right? I think in that sense, I think AI for longevity would be very cool. And if I were to look at 5 to 10 year, if I can, and said, now let's move on from AI, then there are 3 areas. I think one, quantum computing. I always thought it may be 10 years later, but where I'm seeing the talent and the engineering and the startup that's coming, we think that quantum computing may be here in less than 3 years. I think it's there. Number 2, in terms of energy, a lot of conversations about energy, right? And so nuclear energy, the different components, sensors, startups, there's also a lot of activity here, not just in the big markets like US and China, but across the board. I think governments are taking a very active approach to think about how to resolve the energy issue, and nuclear is a key. And of course, I think last, if we're all tracking the SpaceX IPO, I would say that the conversations around compute in space A level, we are already seeing, quite a bunch of emerging startups trying to really address the issue of, if you can get compute to space, which is where the launchers will help, then what does it take to build real compute in space? So those would be the 3, so-called next areas or next frontier.
It's a long list, Mingchen.
I need more than 100.
I answered the question on the portfolio construction, but I can answer the question in a little bit different way. So I think in the private markets, the bright spot for us is 3 things. One is buyouts, as I mentioned. One is secondary. Another is infra. So these 3 strategy within private markets globally, we think are three most attractive, interesting strategy to pursue.
That also sounds like a bigger checkbook, but that's all the time we have. And thank you so much for your insights. Let's give them a round of applause. Thank you.